first session we were dealing with problems. But that's the end of? We must escalate what? Solutions. So I want to introduce you to something we call treasury operating system. Yeah? Just the same way, if you have an iPhone, you have an iOS. If you have an iPhone, you have an Android operating system, isn't it? Eh? The reason why the CFO role has been captured and now is only doing bookkeeping roles, crisis management, reporting what has happened, yeah, is because our operating system has failed us. We don't have a treasury operating system. It's an afterthought. Yeah? We are hitting the numbers, the revenues are coming in, but we're not hitting the cash flows. Our investment income line is thin. Think about Safaricom, by the way. Safaricom, when you pay for your airtime, it's instant, isn't it? Eh? So they have 0 collection period, isn't it? Eh? And then they pay their suppliers after 30 days if they are good citizens. Those guys are as good as a bank. Yeah? How much is their revenue? No, that's profit. The revenue, I know it was projected to be around 206 billion. 206 billion. Yes. Yeah? Yes. 206 billion. Not in receivable. Mostly in cash. So I want you to imagine the role of a CFO in Safaricom. You are in command of 200 billion just in 6 months. If you sleep on daily cash flow, one day, if you don't use those, if you don't have a treasury operating software or system, one day can cost you how much another company makes for a whole year. So you need what? A treasury operating system. By now you know, I don't like talking to myself. So let's answer this question. Look at your balance sheet. Yeah? Where does most of your working capital actually sit? Let's first of all find out so that we see how to apply this Do you need a treasury operating software? It's easy what to call current account. It's working. It is me who is being surprised. How much of your operating cash flow, where is your operating cash flow sitting? So far, 11 out of 12 out of 1 is in current account. Money market fund has showed up. And I mean, most of it, if you have put it in several buckets, just put the big chunk where it has been put. There's one bold one that has come, trapped in operations. It's good to be courageous, eh? Tunasema mambo ilivyo, si ndio? Tukitoka hapa ikuwe imetutoka. Somebody do for me that percentage. This is 18 out of what? Yeah? 78% of all our money in this room is seated in current account. Has anybody seen how much money banks are making? Yeah? I think so. Is it Equity Bank? What was their half-year result? Not half-year. That is three quarters of the year. Was it 40-something billion? I think 42 billion. They made 42 billion shillings in 9 months. Equity Bank. Guess whose money they are using? Our money. And then we go and borrow from, and they charge us more money and they make more. But we've given our money for free. We've given our money for free. If it means 20 out of 26 of us, we are earning less than inflation rate. Okay? And the idea of a treasury operating system is to move you on the yield curve from where you are earning nothing to where you are earning above inflation. There's somebody who said that they work in a circle. That was Anne. It was you, eh? He said you work in a circle and the regulations require you to hold some cash, isn't it? Eh? But does the regulation say that that the money has to be idle? So we can do something about it. We all need treasury operating system. If you don't have a strategy, everybody else will have you for lunch, and banks are having us for lunch. And supper, eh? And dessert. So let's do one more before I go into this. Then I want us to answer the question, why is our cash sitting where it is? Why is our cash sitting where it is? And thank you all for your candidness. I really appreciate this. We'll actually put this presentation together and send it to Ronald's, and they will send it to you so that you can also see these numbers and you can reflect on them, so that when we meet next time, we can have a different picture. Ronald, let me throw you a question, as people are doing this. When you're employing a CFO, or you're helping a customer to get a CFO, what do you usually have in mind?
Mostly it's financial strategy. How can the CFO contribute to the overall strategy of the organization? Not from necessarily an operational perspective, but from a strategic positioning in terms of optimization of their assets, in terms of liquidity, at the same time try to unlock more opportunities and increase profitability. It's not easy to get a CFO in this market.
A good one.
We will have so many CFOs. Most CFOs are trapped up in bank reconciliations, isn't it? Bookkeeping. And also, so it's not easy. So if you capture what we have said here, you will be a very competitive CFO. You will be the most wanted. Most wanted CFO.
Yeah.
But also, I can just comment on some of the things you say.
Yes.
And one of the things I liked about you to say is that you hold cash, but ethically. You know, when I was a CFO, I was told, by the way, pay your suppliers only when they are threatening to murder you. Yeah, so ethically. But anyway, that means that you have to hold cash as long as possible. But then I also want to say that most organizations don't have idle cash and they don't have investment. So they're just in a roller coaster, isn't it?
Yeah,
Of
cash
making
crunch.
money and paying operations.
Yeah.
So, they have no deliberate strategy, especially most of the Kenyan enterprises, especially from my audit experience. And they think they are okay, isn't it? So as CFOs, how do you lead an organization to have available cash for investment? See, that's why you find that CFOs think their role is to collect and pay suppliers and pay employees. But there is nothing left for
The organization, the shareholder.
Yeah, that is why you see, when companies are on sale, they are mostly bought by foreign private equity firms. There are no local private equity, or even private. Only KCBA so now is buying some companies. But locally, most companies have no capacity to even buy another company because they are even in trouble just paying their own bills. So I believe this topic is very important. How do you, first is not how do you invest your idle cash. How do you create fast idle cash? The biggest problem is not having idle cash, but investing the idle, first availing idle cash, and now divesting. And some organizations are just trapped in paying loans. Interest. If you pay interest on the banks, and you pay salaries and your suppliers, that is a ceremony. Isn't it? Actually, I was reading the story of Walmart. They came up with a strategic objective to build buffer cash and gain competitive edge. I was seeing the two companies boasting, Coke and this other competitor is called what? Pepsi. Coke is boasting that it's making profit and huge revenue. Pepsi is boasting it as it is very liquid. Which one will you buy in? Is it high revenue and high profitability without liquidity, or high liquidity in terms of which has been divested now into investment? That will what give you. So idle cash is a strategy. Then now you divest it into this one particular investment. That will really put you on. So as a CFO, as you retreat back, is build a strategy for your organizations to have money. Because I've seen organizations that are doing very well, huge turnover, profitability, but no cash flow, no money in the bank. Of course, with huge ODs, and then the money is trapped in receivables. And I like what my colleague, my neighbor here was saying. We were arguing, and she says that, for them, they have very huge receivables, and yet the shareholders are pushing for what? For them to invest. So I was telling her, why don't you just charge your customers interest on outstanding receivable, and then you say you are also invested in the receivables because you'll have interest income on receivables. Yeah, and you need to negotiate and push back for the insurance company.
Yeah.
Because they are actually using your money.
Yeah.
So the issue of them bringing contracts and signing means you are vulnerable. How do you create capacity as a hospital? You are able to sit with the insurance company and say, it's not just what you say. If you don't pay me within these days, the money comes with an interest. Because I see when insurance companies take a lot of hospitals and clinics and pharmaceuticals for a ride. Because they will not pay, they want to act as the big brother, isn't it? And bully you because they're giving you business, but you're financing them. Yeah, but again, you can also be smart. If you're not willing to pay me within 30 days, we have to increase the rates higher so that you can pay your bank interest. And don't go. You see now they want to push you on the rates, and also they don't want to pay. Yeah. Anyway, thanks.
Let's give him a clap. There is another strategy, by the way, and if you are bold enough, you can apply it, but don't quote me. Don't quote. If a customer owes you 2 million. Send him a statement saying they owe you 12 million. They will quickly reconcile. To confirm that they actually owe you how much?
2 million.
And they will be very quick to pay to get rid of you. Then you've gotten your 2 million. I'm doing this a bit with the light of touch. Eh?
Yeah.
But have you ever received a bill from KPLC saying that you owe them 100,000? And there is no way you can justify that. Eh? You're very quick to pay whatever you owe. Don't quote me, it's not something I recommend. Anyway, this whole thing of collection is not a number thing. This whole thing of collection is a human behavior thing. And you need to step out as a CFO and realize you're dealing with people. When you deal with people and you treat them as people and you engage them as people, not as numbers, you will get your numbers. Does that make sense? Yeah. But back to this. You know, the number one reason in this room why we are holding our money in idle current accounts is because we have been sold this idea that when you are crossing the road, you can be hit by a car. Now we no longer cross. That's the same thing that we are saying here. That liquidity and safety is what is holding us back, that we are not even doing our job. Does that make sense? You will not get on a flight because if a plane crashes, everybody dies. Isn't it? Eh? But how many times does it happen? Isn't it? Eh? So that's very interesting. The second one is lack of clear investment policy. So the question is, in this room, whose job is it to make sure we have clear investment policy? If not the CFO, then it can only be the CEO. Sindio? And if you go to the CEO and you say we don't have a clear investment policy, you will be fired. Because he'll be wondering, why do I have a CFO? Do you see? So, these are problems within our control. Yeah? Approval, bureaucracy, governance. You know, again, the biggest influencer besides the CEO is the CFO. In fact, if the CEO in your organization ever leaves and you're not promoted to become the CEO, you need to ask yourself some tough questions. Right? What is it that I have not been? And this, if you have not been resolving these issues, you can't be a candidate for it. Are you getting it? So we must be the drivers. We are the ones who are on the driving seat. We are your work is to make your CEO shine. Your work is to escalate solutions, not problems. Yeah. So this is very interesting. And we'll keep it there. I quickly need a charger for my laptop before it goes off. Someone help. So the idea is, how do we move from idle liquidity to a revenue line? But just by a show of hand, in this sitting, how many companies here have revenue line as one of the investment income as one of your revenue lines? When you report your audited accounts, there is one of your revenue lines is what? Investment income line. How many companies here have? This is where we start whistling, eh? I honestly believe, in addition to what Ronald said, yeah, that we not only create that excess cash flow, but we also invest. Every company must have what? Investment income line. And look at it positively. It means when you live here, yeah, you have the powers, you have the tools to introduce a new revenue line in your business. And your directors, the board, the CEO will thank you forever. Yeah? It's a low-hanging fruit for you to shine. Because it doesn't require much. Yeah? So, transform surplus cash from a passive asset into an active contributor to the bottom line. One of my goals, let me give this example. Just before COVID, 2018, we were doing as an organization an exercise we called 4DX, the 4 disciplines of execution. And you sit down with your team and you ask yourself, as a team, what is the one world thing, if we did, would transform our organization? And very surprisingly, for us was to have revenue per month. The revenues that we make in a month to be recurrent, to be at a certain level. And said, oh, okay. And we made that our goal. When we started working on that goal, we started mobilizing excess cash flow, and that excess cash flow would go into our portfolio, now the company portfolio, which we are calling our prop fund, proprietary fund. And it started making for us $1 million a month, $2 million a month, $3 million a month. And we are still working on it even today. But when COVID struck, nobody had anticipated COVID. Yeah? Remember, you could not open your office, you could not sell. There was no way of making a sale. During COVID, that portfolio was paying our salaries. We didn't retrench, we didn't do any haircuts. In fact, we recruited some new staff while in COVID because of just one thing: having an in-house portfolio that was generating a revenue line. And you see, imagine this thing that we are discussing right here, yeah, you could grow it, and it could be one of your legacies in your organization, because it could be sufficient to fund all the salaries in your company. So if you pay salaries of $5 million a month, this thing we are discussing here can actually fund it. So give it a purpose. See, look at even the smallest expense. Rent. We pay $500,000 a month. I want to target my portfolio here to be paying rent, $500 a month. Start from there. Then, once that is done, target something bigger. You go on like that, you might be surprised, with that portfolio, you start paying a third, even 50% of your monthly operating expenses. And you'll be the most strategic CFO that the company has ever had. So this is what this is all about. Deloitte they did a treasury survey that showed that top quartile CFOs, yeah, they generate an average of 1.3% or extra return on sales. So, this thing, I remember when we were accountants, we were always considered to be the guys in the back end. Yeah? And if you're in the back end, you don't have much negotiation power. Yeah? Your sales guys have the attention of your CEO. They have the attention of your board. But if you're just a custodian, you don't have the attention of everybody. Even to negotiate your own salary is a problem. You get, eh? Now, if you start showing impact on the return on sales, people start seeing your value. Now you move from back end to front line. Yeah? So imagine, you call Jerry. Imagine Jerry, you're the CFO of Safaricom, and this is where you say amen, because I'm prophesying. Okay, you're the CFO of a very large company that makes 200 billion shillings in 6 months. And you have a return, you with your own actions, initiatives, you boost an extra 1.2% return on sales. Your salary, your salary, if you take that number, divide by your salary, it is a number that is insignificant. You only need to go and show your CEO. Ebu, look at my value add and look at my salary. Different conversation, isn't it? Eh? Yeah. So, how do you do this? Lead treasury, instruments, supply chain financing, and we're going to discuss most of this in the next few minutes. So, the reason why all of you are having all these struggles is because we don't have a disciplined capital allocation framework. We don't have a disciplined capital allocation formula. By the way, let me give you guys a story. You know, this conversation we are having is not just for your companies, it's also for your personal portfolios. So 2018, our parent company, Centum, sold their stake in UAP. UAP now called Old Mutual. And the late Dr. Chris Kirubi also had a stake. So Centum and Chris Kirubi combined their stake and sold to a strategic investor, which is Old Mutual. And they're based in South Africa. So they sent the money to CK. Now, forget Centum. They sent the money to CK. 3.6 billion shillings. Ask your neighbor, how would you feel when you receive 3.6 billion shillings? Yeah? It will be difficult to show up at work, isn't it? Eh? It will be very difficult. Eh? Now, listen to this. What shocked me, the day the late Dr. CK received his 3.6 billion, he was so angry. He was so annoyed, and nobody could understand him. And we discovered why he was annoyed. He was annoyed because he was expecting that money like 2 days before, and it was delayed by. He called everybody, every bank that was involved in that transaction, from Kenya to South Africa, asking to be compensated for, because his money was idle for. That day, I understood what it means, and why some people are billionaires and others are not. Because he did not look at what had hit the account. He looked at what he had missed. The opportunity. Somebody used my money to make money for 2 days. So the thing we are discussing here is not a numbers thing, it's a mindset thing. Are we together? It's a mindset thing. What we are seeing in all these graphs, all these polls, it's reflecting on our how we think. I cannot tell you how many senior executives in South Africa, they called him and they promised him the whole world to make it up for him. And I'm sure he got something in. He got something in return. And that is how a CFO should be behaving. When a customer delays your 100 million with 2 days, you should make noise. Yeah? Even hell should know there's a problem up there. And I tell you, your CEO will look at you differently. You'll be the most valuable asset to him or her. Because they'll know you have a heart. You have a heart for what he cares most about. So, disciplined capital allocation framework is super critical. So, prevent value-destructive empire building with a rigorous stage-gate process for every investment. So, remember, the number one thing that has made most of us to hold cash in idle accounts is because of liquidity and safety. But how we are doing it like the guy who hid his talent, yeah, from his master, after his master entrusted him. That should never be us. Instead, what we should be doing is to be very strategic about it. Does this investment, is it a strategic fit to all my constraints and desires for my organization? Yeah? Does it pass my financial appraisal? Is it within our risk appetite? So these things need to have been defined. The reason why, again, you've seen number 2 was there is no clear investment policy, isn't it? So your investment policy should be able to help you to know what is the risk appetite of the organization. Yeah? So that you don't have to go and consult the board chair, the CEO, for every financial decision that you're making. Let these things be pre-approved, isn't it? Post-investment review. Have your team review. Have your team present to your board, to your CEO, to the ExCo, on the impact we are not just receiving cash flows. We are not just making sure our cash flows are safe, but we're also making sure that our cash flows remain in a state of multiplication. Yeah? So a comprehensive governance checklist should be provided to ensure capital discipline. Your treasury operating system, that is a general structure that you should be thinking about. Yeah? Structure, you segregate and you secure your cash. So for the cash flows, yeah, we spoke about here, there is money that is needed quickly, isn't it? When people need to be paid, when you need to pay salaries, when you need to pay suppliers, money needs to be available, isn't it? That is your operational cash flow. Are you together? That's your operational cash flow. That, where you put that money, first of all, that money should not be in a current account, lying idle. It should be in an instrument that has maximum 30 days tenure. So it should still be earning something. And day-to-day business, it should be available. You should be able to collect it within a very short period of time to be able to meet your liquidity demands. Then When you move from there, then the other is what you call a core reserve. Core reserve are those, they are liquidity events, they won't happen this month, but they will also not wait until next year. Those ones, you put them in a core reserve. Yeah? So this is a strategic buffer. It will give you slightly better yield than here in the operational. And you put it in instruments of a maximum of 180 days. That's your core reserve. Our mindset, we are now showing it in our structure. And then there's that cash flow. We may not need it for at least 1 year, but it's a very important asset to the company. This should go to your strategic bucket. Yeah? And this should be for your long-term growth. Yeah? Should generate returns much higher than operational, than core reserve. Yeah? Much higher yield. It should have a managed risk. There is no investment without risk. First of all, let's agree on that. Even coming here, we took risk. Yeah? Even right now we are here, we are still taking risk. So here, you're looking at 1 year plus. That is your core reserve. Strategic reserve. So when you think about your working capital, yeah, it should never be in one bucket. You see? See, what this picture tells me, most of us, when you look at our working capital, it's one pot. It should be at least three pots, 3 buckets. So we've taken even strategic reserve, we are investing it, or we are treating it as if it is operational reserve. Now, these investments, they should be governed by a clear investment policy guideline, which we'll speak about later today. That tells you the risk tolerance, any escalation matrix, and also the review cycle. Yeah. How do you build your three-tier liquidity ladder? 3-tier liquidity ladder. Tell your neighbor, build a 3-tier liquidity ladder. So your operational reserve, which is tier 1, it should be going to these 3 or a combination of these 3. Let me start from call and fixed deposit, which is the natural place for most of us. The bank is in the business of making money. And what the bank does, it guarantees you a return, or so it says. There is nothing like guarantee in the world of investment. It gives you a fixed return, but you cannot go and ask the bank, where did you invest my money? Yeah? And how much did you make from my money? It tells you, I'm giving you 6%, don't ask me many questions. So, if the treasury bills are at 6%, 8%, the bank is highly unlikely to give you 8%, because then it is doing work for nothing, isn't it? So that's why you find call and fixed deposits are usually, you have to negotiate really hard, and also they're usually lowest in the market. If you're not satisfied with this, and you You are ready to go into capital markets, you can put money in a 3-month treasury bills, 91-day treasury bill. You'll get a higher return, most likely, but also, and it's a very liquid thing. You will not make any losses unless the government collapses. But you have only one problem with this one. It's a 91-day treasury bill, which means if you need the money, you have to sell, isn't it? But nobody is in the market buying and selling treasury bills. And that's why most accountants are locked where? There. Money market fund is the fund managed. Money market funds are run by fund managers under the capital market regulations, which is different from the banking regulations. Now, the capital market regulations are so radically bent to protect the investor, because that's where this is about the investor, that everything that is done in a money market fund or any of the other capital markets funds, they benefit the customer more than the fund manager. That's why fund managers, unlike banks, are required to report the yield on a daily basis. Okay? You must report every day, because who owns the money market fund? Who owns the money market fund? RISPA. Who owns the money market fund? It's okay, you can try.
I think it's the investor in Safari.
Yes. That's the difference. A call deposit is owned by the bank. Fixed deposit is owned by the bank. But I mean the account. But this fund is owned by investors, not by the fund. Everybody else, including the fund manager, are just service providers. So everybody works for the investor. And therefore, even if the money market fund, when you're entering, it was promising 12%, but rates go to 18%, guess what you'll get? 18%. They invest in the same things that the banks do, only that this time they invest, the person who's really investing are the investors. And that's why money market funds tend to give higher yield than fixed deposit and the downside of money market funds. Money market funds don't give a fixed return. We are required by the regulator to give everything to the customer other than our fees. And therefore, we cannot predict what we'll give you tomorrow. Does that make sense? Because tomorrow, if you make 16%, 16% belongs to the investor. But also, if it goes down, you also? Yeah. But if it goes down, you can also be assured that the bank deposits are also going down. I'll say this. I've said this publicly, and I'll say it here, even though it always sounds very controversial. Money market funds are safer than bank accounts. It's the best kept secret. Do you want to know why? I knew this practically. Practically. 2016, something happened. Do you guys remember? Chase Bank went down. Yeah. And when Chase Bank went down, many of us, anybody who played in the money field was caught in Chase Bank. Anybody. Yeah? And I remember sitting on this table a table because I was one of the people who were trying to negotiate on behalf of depositors. And I sat on this table and there were 6 of us. And I was the only one representing an institution. And I asked each one of them how much they had in Chase Bank. And on that table, out of the 6 of us, it was 10 billion shillings. 10B. So you can understand why we were seated on that table. And the person who had the lowest exposure was me. The rest were individuals. They had put $1 billion plus each in Chase Bank. But in one announcement, the money was gone. In one announcement, they could not reach, touch, feel their 1 billion plus. In one. So, I learned a very tough lesson. Even though I'm a trained chartered financial analyst, this lesson escaped me until I truly experienced it. We have been taught that the safest investment you can ever make is what? Call? Deposit. But there's one nuance that I never understood. That when I give my money to a bank, it ceases to be my money, it becomes the bank's money. And that's why banks have one of the largest balance sheets, because on the balance sheet of a bank is our money. Yeah? Equity Bank now has trillions, isn't it? Trillions of our money. But now, this is the thing. When a receiver manager steps in, to do administration, he takes the balance sheet. And when he takes the balance sheet, he considered anything that is on balance sheet belongs to the shareholders. Do you get me? Yeah. So, in one announcement, we moved from simple bank depositors to owners of the bank. Because the shareholders, by the time a bank is going into receivership, the value of the shareholders has already been wiped away. The next most important stakeholder is you, the depositor. And now, everybody was saying, please, this also shaped me a lot. They're saying, please, I don't care how much interest you promised me. I don't care how much interest I've earned from you since I started depositing with you. I beg you, just give me back my principal. And I'm like, wow. The most important asset you have is the principal. When that crisis hits, you don't care about the returns, you care about the principal. The only problem, it's like you. Let me use this analogy. It's like your child, your son or daughter goes to the neighbor's house, okay? And then when he's in the neighbor's house, an auctioneer comes. And the auctioneer does not distinguish the neighbor's children from your. Now your child is also part of the we try to make this point. We are just depositors. Yeah, nothing. And another reality, according to the Kenya Deposit Protection Fund, the only amount of money that you can access when a bank goes under is how much? Maximum 1 million. 1 million. So, Jerry, you're a billionaire. Your billion is inside there. And Fred, yeah, is a millionaire. Fred just has 1 million. And you have 1 billion. You'll both be given 1 million. Is that fair? So you guys are custodians of cash. I want you to listen to me as somebody who has gone through this. Because if you deal with money, there is somewhere you will lose money. So I learned something. If you want to go this call and fixed deposit way, if that's what you prefer, never put all your money in one bank. Because first of all, there is no bank that is too big to fail. When all of us want our money, no bank can survive. Right now, you go to equity. Right now, there's a capital flight. Equity is gone. So, a lot of families, a lot of businesses collapsed because they were in this thing called fixed deposit. They wanted 18% in a low interest rate environment. But there is no money market fund that collapsed when Chase Bank collapsed. Why? Because the capital markets regulation is very stringent that you can never invest all the money in a money market fund in one asset. The maximum is what? Is 25%? 25%. So even if peradventure you had put your money in a money market fund and that money market fund manager was so aggressive they put a maximum of 25%, you would only have lost how much? 25%. So would you prefer to lose 100% or 25%? Money market fund is always safer than bank deposit. And again, why? Even if the fund manager goes under, the fund manager does not own the money market fund. The unit holders own the money market fund. So if a fund manager goes under, because the money is never mixed, the regulator will just appoint another fund manager and that will be gone. Regulations are hell-bent to protect the investor. So that's where you'd be thinking on your operational reserve. Core reserve is something here I'm calling a fixed income fund. A fixed income fund is the equivalent of money market fund, only this time it invests in a little bit longer term fixed income instruments compared to a money market fund, so that it can generate returns, better returns for those investors who have more time. Okay? So that's a fixed income fund. Anything else I can add on fixed income fund? Yeah? Oh, fixed income fund, again, according to, if you're investing in a fixed income fund, I'd highly recommend just put money that you don't need in 6 months. But even if you need it, you'll get it. Even if you need it, you'll get it. Just that the instruments that underlie a fixed income fund, if they are sold on an emergency basis, it can occasion loss. And you don't want to be the one triggering that kind of loss. So fund managers, even though they will give you your money within 24 to 48 hours, if you really need it, without penalty, a fixed income fund is preferable when you have at least 6 months. Again, the language in fund management and banking is very different because banking, they will penalize you. Fund management will not penalize you because the regulation is clear. We don't own the money. You own the money. We cannot penalize you for your money. Your money is your money. Okay? Then, now, fixed income fund is good for those people or those institutions that have ticket sizes of less than 100 million. Why am I saying this? If you go and invest in the bond market, Kenyan bond market, yeah? Anybody, listen to this, anybody who invests less than 100 million shillings in the bond market in Kenya is considered to be an odd lot. And therefore, you're a price taker. These are things they don't tell you. Yeah? You're considered to be an odd, you do not determine the price. Because the biggest investors in the bond market are banks and fund managers. And they come with hundreds of millions and billions of shillings. You get it? So if you go and put your 65,000, yeah, that's fine. They will accept you. But the day you realize how small you are is when you want to exit. Because you are telling your broker, I want to exit from my 20 million. And he's like, this is an odd lot. I am looking for anybody who can buy an odd lot. And that odd lot, if another player, big player is quoting it, will quote it below the market. Because like, why am I buying an odd lot? Charles is there. Charles, lift your hand. Charles is invest in this market. He does not do anything less than 100 million. Because that's what he's supposed to do. So why, if you have less than 100 million, come through fixed income fund, because through a fixed income fund, you get the same benefits that other big ticket investors are getting, because the fund manager consolidates all your money into billions of shillings, and when they go to the market, they speak on level terms with KCB, with Equity Bank, with anybody who is buying. So you get the most favorable terms. Are you together? So that's a fixed income fund. Now, if you have 100 million plus of cash reserves, you can talk to Mercy. Where is Mercy? Mercy, lift your hand. Mercy can tailor, using the same concept, something called a treasury management solution that is specifically tailored for you and the organization. So you don't have to go, she'll do the IPS and everything for you, even present to your board, everything. If whatever you need, she'll be able to do it for you. But you'll tailor a solution specifically to address the unique liquidity and treasury needs of your organization. Now, that is a big league. You get it? And what I see customers doing, they would start from here and graduate there. Now, that core reserve should be sitting around here. These are the two big things that you should be looking at for your core reserve. Tier 3, strategic. Again, your treasury management solution, if you are a big ticket person, you should go there. And if you want to go into bonds straight, you can also go into bonds and Eurobonds. I'll talk about Eurobonds a little bit directly, because you're already a large ticket. If you're a large ticket investor. And you can also go into corporate notes. I think it's, I just saw an announcement. Is that correct, Charles? EABL is in the market looking for investors? Isn't it? For corporate bond. How much are they offering? Yeah? 11.8, eh? Because they consider themselves to be very low risk, isn't it? Eh? So their corporate notes, occasionally we have them, which are investment grade. that is another space you can exploit. Yeah, it will expose you to a little bit more risk, but if you work through professionals, they can be able to mitigate for you whatever risks which are there and filter for you the best ones. But it's another place I have seen investors making lots of money. You know, Chris Kirubi, by the way, used to play a lot in this field. Why? When we put our money in the bank, yeah, the current account, fixed deposit, call deposit, where do you think the bank takes it? It lends it to the bonds and the corporates, isn't it? And the corporates. And then they make a good return. They give you the remnants, isn't it? That's how they make their billions. So this is if your board has the appetite, and we can walk through the journey of educating them on the risk. Some things, they sound risky than they are. You get? This is an area that also is very strategic, because then you position your business to grow much faster in terms of cash flows. Are we together? Yes. I'm just seeing people are very serious. Have I gotten too serious? Things have gotten deep, Yes. Things are deep now, Yeah, we said we escalate solutions, not problems. So choose instruments for each tier: balance, yield, liquidity, and risk. It's a balancing act. And you can see why, if our time is consumed, managing crisis, reporting, managing stakeholders, and doing all manner of meetings, it's difficult to do this balancing act. And this is why also, if that is a difficult thing, you could use the expertise of a fund. But a fund manager is one of the cheapest service providers you can get in the market. Very cheap. And they pay themselves, because you pay them out of return. Takeaways. I have spoken for too long. Now is your time to speak. So somebody says they'll do diversification. I want to imagine diversify away from current account, isn't it? And call deposit. Or diversify from putting all your money in one bank. By the way, I pray all of you will never have to experience that pain. But if you ever have to, remember this one thing: never put all your money in one bank. It does not matter how big it is. Never. Whatever you put in one bank, ask yourself, if I lost all this money, would I be okay? Would my organization be okay? That is the level of diversification you should be looking at. Invest in treasury bonds. Daily cash management reviews. Move all cash from bank to money market or other investment. Shorten debt periods. Increase payable period. Reduce inventory. Create a treasury system as soon as possible. It has hit home, Start with operational as I work my way up. Very good. Treasury operations system. Investment policy statement. Two things there. Develop treasury policy, start small, and grow the return on investment. Well done. Maximize returns by managing a portfolio with mixed vehicles with both short and long-term tenures. Well done. investing the free float operational cash flow into money market. Proper cash flow focus. Invest in the right instruments as per the entity's needs. Well done. Develop measures to collect receivables fast and open an investment account to invest. There. Maybe you can't see all of them. Build my cash flow forecast and surpluses to invest in the core. So, that's our talk was. I think, I'm not sure how to show you the rest. I'll figure out how to show you the rest. But I want all of us, just pause. Let's look at this screen. Let's look at this screen. What you're seeing here on this screen is the difference between a treasury department and a treasury business. Where we are coming from is a treasury department. But what we are seeing here is a treasury business. It's a profit center. Yeah? Each one of these answers is a margin waiting to happen. 1% margin, 2% margin. Start watching the margins of the organization. People start, how come our margins are going up? See, this is the reason. You have an investment income line. Yeah? And I think the biggest question to all of us is, are we going to continue talking about it? Or are we going to start profiting from it? That's the question. It's a challenge. I know this is an annual event, and Ronald, this would be good to repoll this and see how we have moved. Yeah? But I hope and pray that the time we are spending here is useful. Yeah. So these are more than words. Yeah. They are tomorrow's liquidity gains. And the only thing I have observed amongst all of us, the only thing that I think stands between us and getting here is our calendars. I know that sounds strange. Is where what consumes most of our time. If we live here and we get absorbed straight into crisis management again, meetings and stakeholder management, and all the other things other than these strategic activities, yeah? What's your name? Mercy. Mercy will not have mercy on us. Yeah? Because life, our shareholders, our CEOs, our stakeholders have been gracious enough. We've come this far with all this brokenness. They've been gracious. You're laughing. Haven't they? But now we know. Let's do something. Let's do something about it. Ask your neighbor, how are you doing? Check their temperature. How are you doing? Yeah? Tell them you're thinking too much. Yeah? Tell them, come back. Come back to Kohapa. We are still here. I can see all of you have gone back to your offices. Nobody is here with me anymore. Eh? Jerry, good to see you back. Solutions. So I want us to, even it has rained, yeah? It is raining. So I'm also saying that may money reign in your organizations. Amen. May money reign. Amen. Let me speak like a Nigerian, like a Nigerian. May money locate you. Eh? May money look for you. Amen. May promotions look for you. Amen. Eh? Amen. May your destiny helpers locate you. Amen. And I am one of them. So, this is a challenge. This is a challenge to all of us. Are you going to live here as an alpha CEO or a beta CEO? You know, I hear all this, I'm an alpha male. Yeah? Alpha female. Yeah? Mas, you're laughing, yeah? Forget that. This is a real deal. Are you alpha CEO, alpha CFO, or beta CFO? Tell your neighbor, I am alpha CFO. Alpha CFO. So, this is just an illustration. What does an alpha CFO do? What will an alpha CFO do after today? What is an alpha CFO doing right now? If you're an alpha CFO, you're already sending messages, emails to the office right now. Unauliza huyo accountant, how much is our bank balance? How long has it been idle? Yeah? Start working on an investment policy right now, not tomorrow. When I arrive in Nairobi, I want us to have a meeting. That is alpha CFO. An alpha CFO, by now, already knows their cash conversion cycle. And there's like, I am cutting my cash conversion cycle by 18 days, by 10 days, by 5 days. That is alpha CFO. Yeah? An alpha CFO right now is already deciding how they are going to invest their surplus. Are you guys feeling challenged? Yeah? You're feeling pressure? I came to put pressure. Yeah, it's increasing. It's increasing, yeah? An alpha CFO, by the time they live here, they have a compelling narrative for all the stakeholders they need to engage on how they need to create an investment income line for their business. You're creating that narrative as we go along. That is alpha, and your enterprise value will go up. Guaranteed. But I don't want to talk about beta CFO, but let's look at it. The traditional bookkeeper. If you prefer to be a beta CFO, guess what you'll continue doing? You'll focus on audit purity. Yeah? Audit purity and cost control. Yeah? These are the things that will continue keeping you busy. You will continue relying on expensive overdrafts. You will continue communicating only historical financials. I'm telling you, these beta CFOs are not in this room. They are not in this room. That is the demon we've been exercising since we started in the morning. Yeah? Their enterprise value will be flat. So, which path will you choose? Ask your neighbor, which path will you choose? Which path will you choose? One man decision, your decision, your personal decision today will determine the value of your company tomorrow. That's how powerful you guys are. I traveled all the way from Nairobi. Yeah? I burnt my fuel. I left my children. I left my wife. I have paid a heavy price to be here. And I believe it's because all of you are very valuable people in your organizations. And because you are, if no one has told you, I want to tell you you're very valuable. And I want to tell you you're enough. In fact, you're more than enough. And the decision that you're thinking right now to make is so important because it's going to determine the value of your company tomorrow, even without consulting any stakeholders. And if you do this, if you guys don't become CEOs in the next 10 years, come and ask me. Because you are going to next level. This is next level.